The OG of investments, Warren Buffett, surely inspired the majority of the people in the market today. Seeing how it's affected each one of us, let's talk about one of his followers who now holds a great amount of fortune by following in his footsteps. Featuring Mohnish Pabrai, or what we like to call him, Moneybagg Mo, a proud Indian American who has managed a hedge fund called Pobrai Investment Fund since 1999. As of November, Pobrai has an estimated net worth of about $120 million, all made possible with the accelerating annual rate of 16% from the year 1995 to 2015. That's pretty good considering the S&P 500 averages around 8% a year. Pobrai said, "The number one skill in investing is patience, extreme patience." And with that, we give you a hint of what he's really doing in his investment journey.
It feels insignificant on any day, but then you turn around 10 years later and it's actually, you're surprised by where you end up. And that's a hallmark of any compounding process, that the greatest returns are delayed.
Welcome to Wealth Gambit. On this channel, we cover the latest stock trends and news. Whether it's a deep dive into the fundamentals of a stock or breaking news, we covered it all here on this channel. If you guys like that type of content, don't forget to like and subscribe to get notified as soon as we drop new videos. Also, shout out to Marky D. Thank you for liking and subscribing. To anyone who has a company they want us to cover, comment down below and we might do a video on it. In this video, we'll go over the 10 commandments of Mohnish Pabrai and how by living by these commandments, he was able to turn $6 million into well over $120 million now. Pobrai once had an IT business. It cost about $6 million way back in 2000, but it wasn't really working out the way he wanted it to. So he then launched Pobrai Investment Funds, which came after Buffett's investment partnerships. His portfolio focuses on India and emerging nations. According to sources, Pobrai seems to have no interest in a company that's 10% undervalued. If he can't see the real deal of why he should invest in a company, he'll definitely let go. Here are his 10 commandments on investment management. Number 1, thou shalt not skim off the top. First up, Mohnish thinks the fee structure in wealth and asset management is whack. He doesn't really like the fixed fee on assets under management. And when you're one of the guys who likes to manage other people's money, then this is for you. Money managers like Pobrai and Grandpa Buffett make money when they can also make money for their clients. Just like when you give out tips after dining out in a restaurant, you pay them service fees whether you like it or not. The question is, did the managers maximize all the capital collected from their clients to get the management fees they deserve? Managers can earn whether investors gain money or not. It's a risk assumed by the clients who put up their assets under their hand. Many argue that this Buffett formula, or perhaps also Pobrai's, is a shot to the moon. How can managers endure the possibility of getting zero returns when their clients earn less than 6% of what they gave in? Just to understand further, let's talk about Grandpa Buffett's homie, Charlie Munger.
Yeah, Buffett copied that from ground, and Mohnish Pabrai is probably here. Mohnish here. Wait, stand up and wave to Mohnish. This man uses the Buffett formula, and always has. He just copied it. And Mohnish has just completed 10 years. He was making up for high water mark, so he took nothing off the top at all for 10 years. He sucked his living out of his own capital for 10 long years, because that's what a good money manager should be cheerfully willing to do. Buffett's formula was he took 25% of the profits, over 6% per annum, with a high water mark. So if the investor didn't get 6%, Buffett would get nothing. And that's Mohnish's system. I like that system.
You know, success doesn't come at your doorstep right away, and Mohnish Pabrai thinks the same way. Holding allows you to compound really big things. This is what Mohnish tells us with his investment management tip. Just like Warren and Charlie, investing in the right assets is a matter of patiently waiting until you find the right one, and it's either you sell it or hold it forever.
But the bottom line is that both Buffett and Munger have said that if you're in the investment management business, what should have already happened before you set up your own shop or started managing other people's money is practice the art with your own limited assets. And if you did well with those assets, you know, the power of compounding is such that even a small amount of money becomes quite significant.
Hopping on to the second one, Mohnish said, thou shalt not have an investment team. Mohnish emphasizes that investment management is an individual pursuit. In simple words, having an analyst on top of an investment manager that handles your money might not be a good idea, as two minds might just blow up, and when you know, they don't think alike. But Pobrai leaves us with yet another thought to ponder. Having to analyze what goes up and down in your investment portfolio is the fun in investing. So why would an investment manager want to let the analyst take over? Number 3, thou shalt accept that thou shalt be wrong at least 1/3 of the time. No matter how good you are, people do make mistakes. And in all fairness, maybe you didn't make a mistake, but out of sheer randomness, things take a turn for the worst in the company you invested in. Always be prepared for things not to turn out how you expect them.
There are a multitude of factors that are going to affect every business into the future. And especially when we're trying to forecast or figure out what happens to a business 5 years from now or 10 years from now.
Just like what Benjamin Graham said in his book, The Intelligent Investor must always be on guard against whichever is unexpected and underestimated. With the way you'll anticipate what could possibly go wrong in your portfolio, here's the take of Ray Dalio. If you're not worried, you need to worry. And if you're worried, you don't need to worry. And this is how Dalio explains it. It means that if you worry about something dangerous, you will take the necessary precautions and protect yourself so you don't have to worry. However, if you don't worry about something risky, you will not take those precautions, which will be even more dangerous. Number 4, thou shalt look for hidden PE or price per earning of 1. Good things are not easily found. Just like treasures hidden in bizarre places, Mohnish tells us to look ahead and find out the price per future earnings that should be trading at a 1x multiple. But to further explain, here's a really good look at the thought.
Then we get to commandment number 4, thou shalt look for hidden PE of 1 stocks. So, here's the way the world works. So maybe there are around, let's say, 50,000 publicly traded companies globally. And let's say I set up a screen which said I want to look at all companies that trade at 40 times earnings or less. The odds are I'd have tens of thousands of businesses that would fit that screen. If then I change that to a PE of 30, I'd still have several thousand businesses. PE of 20, still several thousand. PE of 10, still maybe north of 1,000, maybe well above that. And as I keep tightening that noose, to PE of 5, PE of 3, PE of 1, there will still be some businesses that will slip through. Now, those are the non-hidden PE of 1s. But what we want to look for is the hidden PE of 1, which means they are a PE of 1, but they don't show up as such on a screen. So for example, and they can be a PE of 1 based on future earnings. They may not be a PE of 1 on today's earnings. I mean, in 2012, when I invested in Fiat Chrysler, it was trading at less than $5 a share. The company had forecasted that in a few years, actually 2018, that they would make about $5 a share. And actually, as we are coming into 2018, they spun off Ferrari. But if I include the whole pie, including Ferrari, they exceeded that number. So what we paid in 2012, PE of 1, materialized in 2018. And so the end result is that investment went up 7 or 8x in that period. So generally speaking, when you do PE of 1s, in general, good things happen to you.
Number 5, thou shalt never use Excel. Here we remember what the great grandpa Buffett always used to say.
I would describe it as we try to stay away from the things to start with that we don't understand. And when I say don't understand, it isn't that I don't understand, what a certain business does. But when I say understand, it means that I think I have a reasonable fix on about what the earning power and competitive position will look like in 5 or 10 years.
Basically, if you have to do some intense mathematical equations to figure out whether or not this is a good deal or not, then there's clearly not enough margin of safety to warrant investing. For example, if a bridge has a weight limit of 15,000 pounds and your truck weighs 14,999 pounds, then just go down the road and find a bridge with a weight limit of 18,000 pounds. You don't want to risk it. Number 6, thou shalt always have a rope to climb out of the deepest well. I'm sure everyone has heard the saying, only invest what you can afford to lose. People make mistakes and it's pretty normal to make some. What's not normal is when you're in a series of unfortunate events that keep you in the same exact place for decades. Contrary to popular belief, you can't just YOLO your entire life savings into the latest trendy coin and expect to be a billionaire. Mohnish said you better find a way to climb out of the misfortune you face or you'll be stuck forever. Just like how Mohnish managed to violate his rule number 5, or focusing on figures when Pobrai funds was on the brink of a financial crisis. The 65 to 70% decline in the funds in 2009 was truly a lesson learned when he looked at those figures from 2010 to 2011 just to make it work all again. Sometimes even the rules you make for yourself are meant to be broken just to get back on track. Number 7, thou shalt be singularly singularly focused. Talking about an Indian epic, Mohnish gets inspiration from Arjuna, an archer who's solely focused on his target. He pulls up and he doesn't miss. And this is the same for investors like us. Block out the noise and just focus on your business. Number 8, thou shalt never short a stock. Clearly, the people shorting SoFi and Tesla stock have never heard this one.
There's no point making bets where the highest upside is a double and the highest downside is that you're out of the game. I shall go to my grave without ever having shorted a stock, and I think you should do the same.
Number 9, thou shalt not introduce leverage. Neither a lender nor a borrower be. Introducing leverage is like playing with fire. You might just get burned. And unfortunately, with leverage, the burn lasts a lot longer than your typical burn wound. After all, it takes 7 or 10 years for bankruptcy to be deleted from your credit report, depending on which chapter of bankruptcy you file. Instead, maybe try to spend less than you earn and use that newfound money to invest with instead of taking out leverage. Number 10, thou shalt be a shameless cloner. People say being unique is a strength, but then Mohnish reiterates that cloning is good for your health. We're all spoon-fed with the figures behind the portfolio of every great investor we know. So, if opportunities are as clear as the sky is blue, then why not? Mohnish thinks it's a great way to keep the effort low but returns high, or at least a way to get a few good ideas to look into. If you would have invested $100,000 in Pobrai's firm in July 1999, it would have grown to around $1.8 million in 2018. And none of that would be possible without Pobrai's 10 commandments. That wraps it up for today's video, guys. Do you agree with Pobrai's 10 commandments? Or is it just not your vibe? If you found any value in this video, please smash that like button. It helps the channel out a lot. Let us know your favorite Pobrai commandment in the comments down below. Until next time, peace.